Hey guys, welcome back to the channel Best Place for Long-Term Stock Investors. Now this week we're going to talk about why the market is dipping, or maybe more than dipping, globally. Even in other markets like crypto, things have been crashing. So we're going to talk about what's really happening, why it's happening, and how we are planning to take advantage of this crash. Now, as a disclaimer, we are invested in some of the industries and even stocks mentioned in this video.
On this Thursday, we'll be having our deep dive, which is Project Small Episode 6, where we'll be covering 3 companies, Delium, Optimax, and 7-Eleven. You can find the link in the description and comments.
So we're going to talk about market crashing. I think we've done videos about this before, but I think it's very good every now and then to talk about
Crashes.
because each crash is different, the causes are different, and of course the opportunities are different, right? Because the crash in January and the crash today, very, very different.
Yeah.
So
I felt that today's crash is more like a, like a slow killer kind of thing.
Yeah. That by 1,000 cuts.
Yeah,
right?
man.
Something like that, right?
It hurts.
So for those of you wondering, if you look at the right and the bottom, right, S&P 500 at the bottom, Nasdaq on the right, you can see they're down like 23 and 14%. 14% for S&P and then 23% for Nasdaq. It's crazy. But our Malaysian stock market is holding. Would you look at that? We are only down 1%.
Yeah, man.
Where is the praise? Right?
Oh, yeah. Kudos to the financial service industry, right?
Yes, and the telcos and all that. But I mean, jokes aside, I mean, if you look at the smaller cap region, right, the tech and then all the others, except commodities, right? It's been tough, right? It's been really tough for especially the small caps, which is where most retail investors, you watching this, probably reside in, or at least ought to reside in.
Yep.
And so that's where some of the pain is happening. And why is this happening? Now, you want to share with us why all this is happening?
Yeah, actually, it's pretty simple. If you just scroll through the news headline, right? One thing is, which is most very common among the investors, which is the e-commerce stocks. So your stocks like Shopify, Amazon, Netflix, even Netflix and Facebook, they are all actually reporting like a drop in earnings in their latest quarters. So actually, the market expect them to do well during times like this, but when they report like such a disaster results, right? Everybody's just start like panicking and just like dump their shares.
And it's also a proxy, I guess, of like an amount of activity is going on in the economy, right? The more of this spending that happens.
We are expecting them to actually do well. But they didn't really perform. So that is actually one of the reason the market crashed in the tech space. That's why you see your Nasdaq is actually down like almost like 20%, right? Yeah, and then another thing is I think we have been talking about this for like almost months already, which is inflation fears and the rise in interest rate. So that's another thing that the market is very fearful of, although I feel that this is actually already adjusted already
to the expectations.
The expectations already. Yeah. And actually there's one more issue, which is China's recent lockdown. Actually, this is actually pretty interesting. Like I'm not sure what I didn't actually really go through on the COVID cases in China. But to find out that they are actually locking down right now, it means that maybe the cases are actually going back going back up again. And then maybe there's not enough. I don't think it's the case. Not enough vaccine.
Or to maybe the vaccine is not at the level that they want it to be.
Yeah. So we are not sure whether this lockdown will actually bring it over to the global country again. And then we're going to be having a lockdown. I don't know what is this, 3.0 or 4.0. Yeah, it's crazy, man. But hopefully there's no lockdown again. If not, our economy is not going to be taking too well for this.
I think just to address some of this, I think with like e-commerce, for example, although I said earlier on, I would say I misspoke earlier on about how e-commerce is a signal of activity in the economy. One thing, and this is probably where investment ideas can come from, is that you have to remember, right? E-commerce is not commerce,
Mm.
right? Commerce is a combination of E and non-E.
Non-E, yep.
And I believe the non-E segment is really coming back because if you look at there's this company in the US called Dillard's. It's something like the Parkson of the US, right? It's not the best analogy, but it's something like that. Do you know that it like 12x, 13x from the bottom of COVID?
Oh.
Department store, you know.
Oh, damn.
So I didn't put it here. Now, department store is not E in that sense, or at least it's not a pure E, right? Yes, they have a website, but people still go physically.
Yep. I think there's another example, which is one of the companies we covered in our previous deep dive, which is TechScam.
There you
So
go.
yeah. So TechScam is like a company that actually provides restaurant services, right? Your Sushi King and whatnot. Their share price actually 2x.
There you go.
Yeah. After COVID times.
Exactly, right? So
Yeah.
I think, so I misspoke, right? E-commerce is not the only indicator. One more thing I want to add is that actually a lot of it is just interest rates as well, right?
Yeah.
So interest rates, how it affects the economy is that a lot of these companies, tech companies or whatnot, they grew through acquisition or
Loan.
which usually needs
Yeah,
debt,
debt, yeah.
right? Or they grow through a lot of VC funding.
Yeah.
And so a lot of these VC funds, right, or angel investors, whatever we're going to call them, a lot of them also borrow money. They have a cost of funding. And so when they pump money into them, but the cost of funding has gone up, i.e. interest rates, then that's when they have to pull back on their valuation. So that's just things I would add to why things are happening. There's never just one reason, but here are some of the reasons.
So Ticker, it is a global financial data aggregator. It is one of the tools that I have actually been using like almost every day in my research, and it has been really very useful because not only it provides data for the financials in Malaysia public listed company, it also provides data for all of the companies globally. And another thing that I love about this tool is that it actually can help you to customize based on the data that you select. So for example, if you want to see how does the revenue growth actually perform, you can actually plot a chart with this tool. So if you want to learn and you want to use this tool, right, you can actually check out the link, which is we're going to put it in our description or in the comments.
All right, so now let's look at the breakdown of the crash in Malaysia specifically, right? So you highlighted here several.
Yep.
I believe the ones you highlighted are the ones that got really hit badly during 2021. So this is
It's basically a comparison between 2022 and 2021's performance.
right.
So if you see, right, the one that I highlighted, which is construction, energy, and healthcare, those three industries are actually got impacted and got hit a lot.
Right.
You can see that healthcare actually
As you
dropped.
see it, right?
Yeah. So you can see that,
4% gloves, basically.
Yeah,
right?
gloves. Yeah.
Energy 21%, and then you've got construction at 17, nearly 18%. Okay, yes, continue.
Yeah. So it's a pretty interesting chart that you can actually get it from Bursa Malaysia. Actually, not only that, I want to highlight on this three industry. If you notice the I believe it's the property industry, right? I didn't really highlight that, but if you notice, right, in 2018 to 2021, it has actually been dropping every single year.
Yeah, that's right.
In 2022. So for those that actually believe that property is a safe haven asset, right? Well,
Or probably companies,
yeah. So now you know lah. It has been like
yes.
mooning in the different direction.
Yes.
Yeah, but what are your thoughts on this crash intensity throughout this?
I think the
industries?
key thing here to recognize is that things always move in a cycle, right?
Yeah.
So, for example, the darling for last year was tech, right? And then in 2020, it was definitely tech, or even 2019, right?
Yep.
So we have like 3 years of a really good run, and then now we are experiencing what a lot of investors experienced for tech in 2017 and 2018, which is a down year, right?
Yeah.
Down years. So you can see the year to date is down 20%. It's probably down more now, right?
Yeah.
Honestly, as of this recording. And, guys like energy, for example, right? They've been down for a long time. And yet, they are inching up, right?
Yep.
But you see, this is like kind of, I believe there's some sort of skew because the guys who are the biggest in this industry probably not moving as fast. Like, you've got Sapura, you've got Sabah causing a lot of these problems, dragging down the index.
Yeah.
But, you've got guys like Hibiscus, you've got guys like Delium, who have, which by the way, we are actually doing research on Delium, interesting company. Please check it out if you want to sign up for the event in the description and the comments. But anyway, so yes, it's true the energy doesn't look like it's like really recovering from the previous lows. But if you look under the hood, really, there are a lot of companies that have done, 50, 100% up. So the only thing I want to let you guys know is that, it's all a cycle, right? For most companies, especially in Malaysia, right? There's very few companies in Malaysia, or globally for that matter, where you have a Facebook, right?
Yeah.
Or you have a Google where every year you're going to make money. We do have companies like that in Malaysia, but you're not going to be able to buy them at a valuation that is cheap, like Nestle, for example, right?
Yeah.
It's already like 30 billion, 35 billion market cap.
Yeah, or you only can get such valuation when they are not at a rising star position, essentially.
Yeah, but I mean, some of these companies are so good that even when they're out of favor, their version of out of favor is flat, not down.
Yeah. Yep.
Right? So the only time you get out of favor industries that have gems and high quality is when they are in some of these cyclical companies like energy, to a lesser extent probably healthcare, right? Some of the glove companies start to look a little bit more interesting now. And then, of course, construction as well. Construction and property, they're quite somewhat linked, right? And so there has been such an unloved industry. And I think your job as an investor is to go into these industries, do the work, sift through all the different companies, and then, make your bets based on your comfort level. But what else do you have to add about this?
Actually, nothing much. Actually, we're going to move on to the next session, which is we're going to talk about how to take advantage in these crashes.
Some of the key things you need to do. Guys, if you watch all the way until now, you definitely like the video, right? Now, all you need to do is not just like it, but actually like it, like click it and smash the like button, for the algorithm. And of course, comment and subscribe. Click on the notification bell so that whenever we got new videos, you'll be updated immediately. Okay, so we talked a little bit about why things are happening, what's happening, and of course, we dug slightly deeper into the different sectors, right, that could be interesting. Now is some of the practical side of things, right? Like if you're, let's paint two scenarios, all right, for those listening. The first is, okay, you have already invested, so maybe you did well in tech or whatever, and your portfolio did pretty well in the past couple of years, but then now it's down, maybe 20%, 30%, whatever it is, right? What do you do? And then the second scenario, maybe
you're not invested.
You're not invested, and you're looking at this. This is the right time to go in. Okay, let's start with the first scenario. So, what do you think people like that should do?
Okay, so if you are the type of person who are fully invested in the market, just like what am I doing right now? Not financial advice, by the way. But so it's sad to see your portfolio down 20-30%. But I think one of the strategy that actually not many people actually implement also, because when they see a market crash, they immediately like panic.
Yeah.
Then they just press the sell button, like get me out of here.
Yep.
But actually, there's another very underrated strategy, which is to do nothing. Yeah, you just let the crash happen, let it run, and then in the end, it is a cycle again. What comes down, you go up again, and what goes up, you go down. So just bear with the crashes, and you can choose to do nothing, or if let's say you do have the cash, actually it is a good time to go for shopping.
Yeah.
Because this is like a very, very rare occasion that you can get great companies at a very cheap valuation. Yeah, that's how I put it.
That is very true. Now, so I think that when the issue with most people when it comes to crashes is that they're not prepared. And so what you actually need to do when you prepare for a crash is to actually do your work before. So usually what we do in our SIB program is that we'll tell people that, hey, you need to be able to research companies really. You need to have create what we call a watch list. So maybe there are 10 stocks or 15 stocks, whatever it is, that maybe the price right now is not very attractive or very attractive to you, or maybe it's like gone up a lot or whatever, because hey, good companies do go up a lot, right? I mean, by definition. So you want to have a list like that and wait, right? So you need that list ready so that whenever something like that, whenever shopping opportunities happen,
you're ready
it's
for
automatic.
It.
Right.
You're ready for
it's automatic. You're already buying these companies.
Yeah.
So that's where you need to be there right now. Now, if you're not there, then even if stocks are falling, I believe you should not be putting money in. You should be doing your homework right now because you didn't do your homework before.
Yeah.
So that's where I would say that's the first thing you probably need to do. Now,
actually, there's one more strategy, which is what is everyone doing right now? If let's say you are planning to sell some of the stocks, which I think you shouldn't, but let's just say that you're holding a company like, I'm not going to name names, but there's this oil and gas company called, start with S1. Let's say you're holding that company, right? And you see that the fundamentals and everything is just deteriorating.
Yes.
Not financial advice, but I personally would start trimming some position from that kind of bad stock.
Sure.
Bad stock.
So, see, you raise a good point because at the end of the day, you should not be selling because the market is crashing. You should be selling because the fundamentals are bad, whether it's the financials, whether it's the management, whether it's the industry outlook is bad, right? So those are the reasons to sell, not because the price has gone down.
Yeah,
right?
Exactly.
The reason you feel insecure when the price goes down is because you don't really understand the asset, right? If today, the example I always give is if let's say you have a house in a prime area like Bangsa, let's say, if it drops 30%, you're not going to sell your house like, I'm going to sell my house because it drops 30%. No, you're probably looking around your neighborhood, hey, like, any other houses available? Maybe I can pick it up for cheap, right?
Yeah.
Why is it that you're able to say that? Because you know Bangsa is a well-connected area. It is, better than average in terms of hygiene. It is maybe at a certain social class and things like that. So it makes the property value higher. It's the exact same thing with stocks, right? Is it in a good environment, economic environment? Is it run by a smart guy, an honest guy? Is it backed by good financials? Let's say these are the key things that you really want to look at when you do it, so that whenever you immediately know when prices move whether you should buy or sell. Okay, so this question is by a long-time follower, right? Mr. or Mrs. I don't know, Annette Lim8, Annette.Lim8, and he/she is asking, how did everyone got conned by SD? What company is this? No idea. And how to avoid in the future this sort of bleep company. So I'll go first, then you can add to it.
Sure.
So the way you avoid companies that have a chance of, whether you want to use the word fraud or irregularities,
hidden red flags.
Yes, red flags and things like that, is to always first start with the financial statements, right? Because although financial statements are not everything, they cannot paint for you a HD picture or 1080p picture of the company. What it can do is to paint for you a 360 or 480p view of the company. For those of you all who watch YouTube videos, you know what I'm talking about. And if you don't, go look it up, right? So you will not see the full picture with financials, but you get a good grasp of what, the Malaysia, what the situation of the company is. So you want to start there. Now, what specifically do you look at whenever you look at the financials? Now, you should be looking at all three, right? And we actually go deep into this for our SIB program to show you how they all link together. But if you only have to look at one, please look at the cash flow statements, because the cash flow statements is there to record the real and true activities of the company. Meaning to say, what exactly is happening to the company on a financial level. So, is there cash coming in or is there cash going out? Well, if cash is coming in, why is it coming in? Is it because of the business or is it because of loans? And if cash is going out, why is it going out? Is it because they're used to pay a lot of debt, or is it because they're using to invest a lot of this money? So from there alone, you can actually avoid like 90% of companies in terms of whether you should invest in them, because a lot of these companies really don't have the right kind of cash flow statements to begin with. Now, once you've identified this sort, you can make a decision and say, okay, look, this is not a cash flow statement that I like, right? Every year, they don't generate enough cash. Every year, they have to borrow money to survive, right? You can just stop there and say, I don't care. Now, some companies need to actually borrow money at the beginning and have negative cash flows because they are growing. So, of course, you can say, hey, I'm not going to entertain any of these companies. Or if you would like to take the additional step, which is not a wrong step as well, to actually figure out why they're spending that a lot of money, amount of money. So that leads me to the next, the second red flag, which is, okay, they're not making money, they're spending a lot on investments, presumably for the future. Okay, what are these projects or new business units that they're spending money on? Do they make sense? And so in a lot of cases, they don't make sense, or they're investing money into a low return business. So this company, SD, so to speak, they had a pretty decent, you can say, business before investing into the, you can say, the oil and gas construction business. What they were doing was a lot simpler, a lot less complex, and now they're doing something infinitely harder, which, as we can see now, they perhaps lack the expertise to do. So that's where you need to think very hard, right? If you don't want to think hard, then you just say, no, cash flow statement is bad, I avoid. But if you want to go deeper, you have to say, okay, what are they investing in? Is it realistic? What is the likelihood that the management will execute these plans? How to know that? Well, you look back in the past. What have they achieved and things like that. Then there's another additional step, the third one, of actually, going to online to see if there's any interviews, written or verbal, about the management. And this is where your sixth sense will have to come in. When you hear the guy, does he actually talk about what's reasonable, and does he provide good reasons why his projections and his goals are actually good? Or is he just a salesman, right? So these are things you really have to think about. But what are some of your other red flags that you would add?
Well, actually, you painted it out very well. So in my opinion, right, when I'm trying to figure out if this company is hanky-panky or not, so the first thing is that I need to know whether is their one thing is how is their business, what industry they are in. Yeah, and then is their fundamentals behaving like what are their peers are doing. Mm-hmm. So if let's say there's something that is inconsistent with their peers, right? Because normally if you are in the same industry, chances are your business model are kind of similar to your direct competitors, not to say indirect one. But if let's say if this company is behaving slightly different, like they manage to get more profits consistently every single year than their competitor who actually is in a very volatile industry. Let's say it is a cyclical industry and it's their profits are not consistent at all. Right. But if this company is going on an uptrend trajectory, and it looks very too good to be true, that is actually where it signaled me kind of a red flag first. Maybe I put it as a yellow flag or orange flag first. Because I still need to justify whether is it really that great of a company, right? Yes. So that is actually one of how I analyze a company. First is basically see how it compares with its peers. Compare with its peers. Whether is it too good to be true. And another thing is, I think you pointed it out just now, which is how often do they raise their share capital. Mm-hmm. Basically, whether are they always raising fund from the shareholders. Yeah. If they have been consistently doing that for every single year for God know what reason, maybe to finance their working capital or whatever business, right? Actually, it is a red flag to me, I consider, because I want to invest in a business that can generate cash flow by themselves without the need to rely on shareholders' money. Not as much as. The
only caveat I will add to that is that if the management, again, it goes back to the management. If the management is good, raising funds, whether through the bank or through shareholders, can be a good idea. It's a very rare instance. I think in Malaysia, the one company that always comes to mind is Yinsen Holdings. They're an FPSO business, oil and gas business. And they have shown that, they're probably the only company I know that they've shown where, hey, if we raise money, if we dilute shareholders, actually that's more beneficial to the shareholders because the kind of things we're investing in has a long runway. So it has a lot of business continuity. And so that actually helps with, even in the future when they borrow money instead of raising funds to expand the business. And so these are some caveats, right? There's no iron laws in investing by and large. things are only true for most of the situations where the opposite can be true. And I guess we'll bring an end to the video. If you enjoyed the video, of course, share it with some of your friends and family members who might find it useful. Come follow us on Instagram, join our Telegram groups to get updates. And you know what? We'll see you in the next video.